Hello and welcome to this ET Now special. You're watching Budget and India Inc. with Uday Kotak. Mr. Kotak, thank you so much for joining us right here on ET Now. The talk this time is all about fiscal prudence. How easy is it going to be for the government to tighten the fisc at a time when we're staring at a decade-low economic growth?
If you look at the world today, you have two models, one in the US and the second one in Europe. The US model is loose fisc and loose monetary policy. The European model is tightening fisc slowly but loosening monetary policy. And in India, you have the challenge of making the choices. The difference between the US and the European situation vis-a-vis India is the wrinkle on inflation. Indian inflation is higher than either Europe or US, so we have to factor that in as well. And combine that with the fact that we have a significant current account deficit. Therefore, we are at a stage where we have a very difficult choice to take a risk on one of the two parameters, which is either growth or inflation. And as I think about this from a fiscal point of view, the policy seems to be prudence. Therefore, we will improve our fiscal situation, and that's a stated policy position. Which then brings us to the monetary policy choice, which is a very tough choice between focusing on inflation or growth. We're probably at a stage where we cannot ensure both, that is, improving growth and lowering inflation that easily at the same time. I therefore feel that while we cannot dramatically reduce interest rates, we need to gradually keep on improving in terms of reducing interest rates gradually there as we gradually improve the fiscal situation.
But you do believe that options are limited for the government to boost investment and in turn growth at a time when the fiscal deficit is where it is?
That is the challenge, and unfortunately we are in this situation 1 year before an election. So the government is having the very difficult choice of tightening the fisc when it has to face the voter in about a year's time.
Do you think there's a possibility of the government surprising the markets with a fiscal deficit number better than 5.3% for FY13? Because there's been a lot of talk about steps taken. The borrowing has also come down in the last tranche. Is that a possibility?
I think 5.3 is a good number compared to where we were even a few months ago. And one has to watch also what is the plan for the next year, which the stated numbers is 4.8. And I would be very, very satisfied if we stuck to the numbers we have given, because a further tightening of fisc also means we're taking so much money away from the marketplace.
The government still seems confident of 6.5% growth in FY14. What's your sense? Do you get that feeling on ground? Do you think is the sentiment turning so sharply for us to look at 6.5% growth in FY14?
Frankly, I am in the camp which is more at this stage 5 to 5.5% growth into 13-14.
Even in FY14.
More importantly, we should be able to stabilize at those levels and not have the risk of slipping further. And you have to keep in mind that growth puts pressure on current account as well, unless a lot of the growth is export oriented, which is not very likely.
I want to talk about the current account, but what according to you could potentially turn the investment cycle? Because we've seen a slew of reforms over the last 4-5 months. Sentiment has changed, but the investment cycle hasn't quite turned, and we're not seeing signs of it as well.
I think investment cycle needs two things. One is long-term confidence, and the second is attractive rates of interest. At this stage, my view is we are probably 12 months away from a revival of the investment cycle.
You spoke about attractive rates as well. Because of the high fiscal deficit and the now added worry of current account deficit, do you think the central bank also has limited room to cut rates? By how much do you think it could look at a rate cut through the course of this year?
Calendar 2013, by end of this year, my sense is we could see the policy rate at around 7% from the current 7.75. So a 75 basis points cut between now and end of the year.
Given the state of fundamentals and the other macroeconomic concerns, do you then believe that markets are actually, in a sense, trading way ahead of fundamentals of the economy?
No, economic reality is certainly tougher than what the markets have been saying so far, especially in the last few months. And a lot of our market valuations are dependent on risk on or risk off global trade, which is the issue. Therefore, if there is a risk off overseas, we see Indian markets correct. I personally believe that the reality at this stage is behind where the markets are, or markets are ahead of reality.
So that correction needs to happen in perception as well. You spoke about the risk on, the risk off trade as well, and every now and then there are these jitters to the risk on trade that we've seen play out over a while now. How worried are you about the fact that the risk on trade could take a serious knock and that could in turn affect the sentiment?
No, I think we will go through most of 2013 reasonably okay. There may be a little volatility from time to time, but overall I think loose monetary policy globally is likely for most of 2013, and therefore even if there are fears of future interest rates going up, I think 2013 we will be able to have a global comfortable and benign liquidity situation.
So you wouldn't read too much into the minutes of the Fed meeting that seems to have caused a lot of nervousness among leaders?
I don't think the Fed does anything in 2013. This is my personal view, and that's the sense one has got in totality. Therefore, we may be coming closer to an end of a loosening cycle, but we are not at the end.
So there's no cause for panic?
No cause for panic. It will be easy money situation globally. But we have to get our act together in the next few months.
In the conference of yours that just got concluded a few days ago, what's the sense that you got speaking to a lot of foreign investors who must have come in as well? They've been the ones pumping in a lot of money into India. Is that confidence still there, or do you see them being a little tentative going forward?
I think the investors are doing a lot more detailing and are focusing bottom up. They are not necessarily very excited at this stage top down. For select companies, attractive valuation and high quality governance, that's the kind of companies investors feel comfortable being with.
But do you think the kind of liquidity that we've seen come in from foreign investors is likely to continue, or do you think that's at risk as well?
The liquidity is really linked to the global liquidity situation, which I feel will be reasonably benign in 2013, and that's the positive. Therefore, portfolio flows give us some comfort to put our corrective action in place.
You spoke about things that we need to do as well to fix our economy and markets. The fact remains that through the course of much of 2012, the retail investor has been completely absent. In fact, he's been absent for years now, and domestic institutions aren't quite buying. What can the government do to get them back to the market, especially the retail investor?
I think you've got to do two things. First of all, the hurdle rate for the retail investor in terms of his alternative investment opportunities, it's very high. Therefore, if you take any individual today with some of the tax breaks he or she can get, his hurdle rate post-tax is 8 to 9%, which is pre-tax 12 to 13% in rupee terms. And that's a pretty high hurdle rate on fixed income to go out and buy equities. So, one, lower interest rates. Number two, we need to build confidence back that investment cycle is happening, growth is encouraged, entrepreneurship and corporate sector will be supported by government, and that kind of confidence will lead to a positive investment cycle, but that's something which will take time. And in the interim, therefore, we need to give what I would call as little bit of steroids to get investors back, which is hopefully some tax breaks in this budget to nudge people into equities.
We saw something in the last budget, the Rajiv Gandhi equity scheme. Do you think we need something in a much bigger, larger scale to bring the retail investor back? Because that clearly didn't have the kind of desired impact.
I think the Rajiv Gandhi equity scheme needs to be modified to be available for any investor and not just a first-time investor. Number two, you need to have it in a larger size, maybe lower percentage. Therefore, against the current 50,000, maybe allow 2 to 3 lakhs and a lower percentage as a tax set-off, so that you attract more money into equities, is something which I would recommend.
But how about disincentivizing? We spoke about this point as well. Disincentivizing investment into other asset classes like gold, which is obviously the reason why we're seeing the current account deficit where it is, or even real estate. Do you think that there's room for something on that front for the government to look at?
I think the government really needs to make sure that there is no arbitrage on things like KYC norms and ease of operating in those markets versus equities. Equities should be able to deal with the competition from gold markets and real estate at par in terms of transaction ease. Today it's far more transparent in the equity markets and less transparent in the other markets, which is creating the arbitrage.
You spoke about the current account deficit, and even for the month of January, we've seen the trade deficit widen. Those are not good signs. And even though the government has taken some steps in terms of trying to curb gold imports, it's clearly not had the kind of impact that anyone would have liked. What do you think should the government do to curb or to tackle this menace of the high current account deficit?
See, it's really in two parts. One is the short term and the second is the long term. In the short run, the two major items are gold and oil. So we need to control gold and transmit the oil prices to the consumers, which is happening, and therefore stay on course on diesel and petrol in terms of transmitting the price to the marketplace, which will again put pressure on demand and therefore growth. But that's the price you pay for getting our current account into better shape. Longer term, it's a fundamental question of competitiveness, and Indian business and the Indian economy has become pretty unproductive, and you will find it in our day-to-day lives. If you have very high rentals and real estate and other input costs for business, that makes India's exportability uncompetitive. And either you then allow a significant depreciation of the currency with all its attendant price, including inflation, or you do fundamentally right things for productivity. The problem today is our currency is also supported at the levels it is, and levels are at say even at 54 by portfolio flows. So if those portfolio flows were not there, the currency would weaken further. Therefore, we need a fundamental adjustment to improve productivity and competitiveness. Improving it fundamentally is better. Depreciation of the currency is not necessarily a good way of improving competitiveness.
So for the year 2013, do you think the currency will remain the same range that it has been, or do you think there's scope for extreme volatility?
Now, my sense on that is I do not see 50. I do not see 60.
Okay, so it'll be in that range. Right. I want to talk about the capital markets as well, Mr. Kotak, because we've seen little activity. There have been a few government issues which have got reasonably okay response, but we haven't seen fresh issues come out in the market from any of private companies. What according to you explains the nature of the primary markets, and what will, in a sense, revive the interest back? Because our markets are still trading at very high multiples.
I think we first need attractive valuations. We need the saver to come back. We are depending too much on the global investor for any IPO. There is got to be a better balance where the Indian savers feels it's worthwhile to put his money in equities versus gold. And you need a very significant mood change for the Indian saver to come back to Indian equities.
We'll slip into a short break on that note, but when we come back, we'll talk about the specific tax proposals that are likely to come through in Budget 2013. Lots more lined up on Budget and India Inc. with Uday Kotak.